I'm excited to bring in our next guest, and that's going to be Mark Minervini. And the reason why we just had Jack Schwager here, and Jack Schwager, obviously, for those of us that have been trading, I've been trading for a quarter of a decade. Michael Guyad, he's like, Blake, did you say you were trading for 45 years? I'm like, did I say 40?
No, I don't think so.
That would have made me 4 years old at that point.
Wonder kid.
Yeah, wonder kid. I know some youngsters that could probably fit that bill at some point. But listening to the likes of Jack Schwager, and then being able to talk to Mark Minervini here very shortly, and I know everybody's waiting for him. He's slated to start in about 2 minutes. Is going to be super exciting. He's like a trader's trader. I'm really excited to dig in to some of these trading questions, and I know there's going to be a ton of questions from the audience. So make sure, if you're in the audience and you're waiting for Mark, and you've been waiting here patiently for him, this is going to be your opportunity to make sure you take some questions, write them down, type them out rather. I don't know who writes it down, anything at this point, right, to make sure you guys type them down. And I'm going to try to field as many as possible. Mark is going to, like I said, bring in a lot of questions, I am sure. I'm going to do my best to answer them all. And is there anything that you guys wanted to say before we bring in Mark?
It's been another great day, and I think it's going to finish in the best possible way, right?
Yeah. Oh, yep. Yeah.
We've got so many messages saying, when is Mark Minervini on? When is Mark Minervini? So I think a lot of people are waiting for him, so I can't wait.
They are, and as soon as I see him come on camera, we'll be bringing him in. And like I said, I'm super excited. I got to show you guys something which I think is great regarding Mark, but he's like the trader's trader. He's like the trader that if you have traded the markets for any period of time, you look up to Mark. So I'm excited to ask him. I got so many questions, and there he is, Mr.
Hi guys,
Mark Minervini. How are you?
Hey, Mark.
Good, thank you. Good, thank you.
Hello.
I just wanted to say thank you so much for being part of the Trader Summit event. I know so many people have been waiting for you patiently, and so thank you for being here.
It's great to be here. I hope you guys have been having a great event, and I hope to contribute to it.
Oh, you are, and your knowledge is going to be. We're just excited to take it all in. I know so many people are waiting for you. So I wanted to get started, and I want to mention that, Mark, you have such an amazing, history, not only as a trader, but as just a successful individual. All around. And I know you were featured in Jack Schwager's book, and but you've also authored a few books of your own. You've had the Think and Trade Like a Champion, Trade Like a Stock Market Wizard, and then Mindset Secrets for Winning. And is that one, that last one, I'm assuming that one you did is not just oriented for traders, is that correct?
No, I mean, it's oriented for everybody, business, sports, trading, anything. And it's just simply the tactics and the strategies and the mindset that I've created for myself over, you said about 45 years. I doubt you're even 40 years old, but at least
I'm 50. I'm turning 50 this
wow,
year,
you look
thank
good.
you. Thank you. I love that.
You look fantastic. So, I've been trading for, it'll be, I think 40 years next year or 39 years next year.
Wow.
So these are just, universal principles that I've used for myself. As a matter of fact, yesterday I did a talk with a group of salespeople, and the first thing I said was, you're probably asking yourself, why is a stock guy here talking to a group of salespeople? But again, they're universal principles, for the mindset.
I was going to say, Mark, getting to learn about you, in recent years, I can't say it's like, just in recent years, I watched some of your videos on you drumming. I mean, amazing, right? And I'm prior military, ex-Marine infantry, 1990 to 94, combat
awesome.
veteran.
Thank you very much.
I watched your pistol competitions, and I shoot out in the desert all the time. I live in the desert, so we run out and blow stuff up all the time and do our own tactical stuff out in the desert. But watching you compete, that is precise, John Wick style amazingness. And but watching you perform in those non-trading tasks make me really want to read your last book, because that truly is some amazing things that you do.
Well, first of all, thank you for your service. I really appreciate it. I love all the military men. You guys are awesome, and thank you so much for protecting us. And I shoot with a lot of ex-military guys, and compete with them too. There's a lot of military guys in the competitions. I'm older now, and I don't have the type of movement I used to have, but still shoot a lot. I have my own shooting range. But I could tell you right now, and people find this strange, but shooting pistols and doing those competitions taught me more about mindset and trading, probably more than trading. And the reason why is because, like trading, some people call me up, my friends, when the stock market's doing really well, they'll call and say, I got to learn about this trading. Can you help me? I want to do something a little easier and not work so hard. And I say, well, you're going to the wrong place, because trading is you're going to work a lot harder trading. And, I tell them, when you go to your job, and you have a bad day or a bad week, you don't find $50,000 has been taken out of your bank account. So there's a lot of pressure. With trading, you get penalized when you make a mistake. With shooting, the penalty is even greater. You can shoot yourself, you can kill somebody or kill yourself. So there's this huge amount of risk involved. So risk management becomes even, more the number one priority in shooting. So yeah, I've learned so much about that. And in my mindset book, there's a lot of examples of things I talk about what I learned, from the shooting competitions.
Well, I found it extremely fascinating, and so I'm excited to talk to you about a few things. But for traders that don't know this, I want to point out something, and I'm going to show my screen really fast, just so everybody can see this. Mark, so in 2021, you won the United States Investing Championship, and you crushed the competition. Now, this is not your first time doing the U.S. trading competition. You also won in 1997. Is that correct?
Yeah, it's about 24 years ago.
That is an amazing. Can you tell us what it's like, first of all, to have this kind of accomplishment, and what it's like to go through the process?
Well, again, everybody told me not to do this because it was all downside. If I didn't win it, it would be a black eye, or would show that I can't do it again. So that precisely is why I did it. I like a challenge. So when everybody said that not to do it, then I immediately said, this is something to do. But anyway, I was in front of that screen every minute of the day and traded, fiercely and just like I did in 97. It's a lot of, if you want to win, you have to realize that you're going to have to go the extra mile and be super aggressive, because I often say, like, people talk about steroids in sports. Well, when you're a NFL linebacker and the guy on the other team on the other side is on steroids, you have to go on steroids or you get mauled. So it's almost, it's a self-fulfilling prophecy, if you will. Same thing with trading in a competition. The other guys are all going to go, hog wild aggressive, and somebody might even get lucky at some point. So you have to be, overly aggressive. So that it puts an additional amount of pressure.
So you're trading a live account. Is it over the course of an entire year, or how's it measured?
Yeah, the U.S. Investing Championship, it's run, of course, by Norm Zeta since the 1980s. I might also point out that, I was inspired by, David Ryan when he won the U.S. Investing Championship 3 years in a row, and other guys who won the U.S. Investing Championship in the 80s. And also Jack Schwager's Market Wizards book, where many of those guys were then profiled in Market Wizards. That's where I got my start, was to be influenced by those guys and read Market Wizards. Larry Height, who is he's in Market Wizards and he's a living legend, is a very good friend of mine now. I talk to him almost every week. Guys like Stan Weinstein, a lot of these Market Wizards have become friends of mine. And of course, David works with me now for, I guess, like 7 or 8 years now. So it's really quite amazing that I started off, idolizing these guys. They're now my friends. Some of them work with me. And so now, that's where I look to do the same and inspire the next generation by, winning those competitions and doing these things is mainly to be inspirational and to show that someone like myself who has an 8th grade education and started with a couple $1,000 can in fact, do this, and you can too.
And that is an amazing story in itself. I dropped out of college so I could pursue a life in finance at the age of 24 and a half or something, right around there. And so I think that's just absolutely, you're truly a legend as far as your stories go. Now, let me talk to you about the trading competition and your philosophy as far as trading goes. Your big mantra is managing risk. So when you have these traders that are taking on these, maybe monster trades or trading super aggressively, like you say, on steroids, how do you manage risk in a situation like that?
Well, you have to be very risk adverse as far as the amount that you allow stocks to go against you, and the more aggressive I am, the bigger my position size, the more I'm going to be a stickler on the risk side. And I'm not going to let that trade go against me too much, because of course the loss would be much greater. It'd be hard to recover from. So the riskier that you get, the more you have to crimp up that stop loss, and the more you're going to have to be on top of things. Just to give you an example of how aggressive that these guys can be and the kind of volatility. Dan Reyes, who was in the competition and is a friend of ours, he's actually a client of ours. He was up in the first, I can't remember the exact number, but I think it was 200% in like the first couple months. And
Wow.
then he just disappeared off the list. And we were wondering what happened to Dan. And then we actually interviewed him on our own platform. And he gave it all back to a 200% profit. And then he ended up finishing, I can't remember if it was 3rd, 4th, or 5th. He ended up finishing in like the top 4 or 5, up, I think, over 100% or 99% or something like that, right around 100%. So that's the kind of, volatility and aggression that you're going to have when somebody's pushing to win a contest.
That is pretty amazing, because you're swinging aggressive size, and your stops probably a little wider to get swings like that. And so that kind of translates into today's market. Mark, how are you dealing with today's volatility that we're seeing? Because it's not, a straight up market. You've got a lot of volatility, a lot of false breakouts, and how are you dealing with risk management in today's market?
So the false breakout theme has been going on for a while. This started all the way back in February of last year, where you had a very peculiar situation where, and I haven't seen too many times going back. I've been through, I think, 8 bull markets and 8 bear markets now, 16, half cycles, if you will, 8 full cycles. And I haven't seen where you had so many stocks set up and break out and so many stocks fail. But the silver lining to that was that you got a lot of moves that were, some of them were just 1 or 2 days, some of them were 5, 6, 7 days, but you'd get stocks that would move up, a considerable amount if you're trading short term. So it gave this incredible opportunity for short term trading. I tweeted that, and we told our customers that, way early on, and I just kept trading that theme and turning that edge over. People have to realize there's more than one way to get to your goal. The real key to trading is to make more on your winners than you lose on your losers, and turn it over as many times as possible. But now, so here's the thing, the turnover part is directly related with what the risk reward ratio is. The wider the ratio is, the less turnover you need. When the ratio is smaller, then you need lots of turnover. That's why a day trader might do 5,000 trades, 10,000 trades a year. They're making, a quarter point, half a point. A long-term investor might make much less, is going to make far, far less trades and hold for the long term. There's drawbacks and strengths to both. But so the bottom line is, I'm always trying to gauge, where is the theme in the market, the technical theme, and then can I apply my strategy to that theme and roll that edge over? Sometimes the answer is no. The stocks aren't meeting your criteria, so you have to sit out and you have to wait. There's other times where, yes, they're meeting your criteria, but now you've got to take maybe a little less on the upside and tighten up that downside and turn that edge over a bit more. And that's what happened during last year. And I think even now, we're probably, we're in a bear market in stocks for certain. The indexes haven't come down as much as a lot of these growth names, but we're certainly in a bear market right now.
So what is your time frame? I guess I got two questions here. What's your time frame in current market conditions? Obviously, the market may dictate, how you approach it, but as of right now, what's your time frame? And then also, well, and then I got another question after that. But what would you say to my first question?
Whatever I can get, I mean, really, that's the time frame.
It's a fair
When you're
answer.
in a bear, when you're in a bear market, you're really, I'm usually in the sidelines doing nothing and waiting for, some signs that the bear market's over. I mean, just recently, and not too, just not too long ago, we started buying stocks again, but keeping the exposure low. So there have been some names, but on balance, half of them are stopping out, half of them are working out, but they're not working out to the extent that I would say, okay, it's time to like play for the bigger move. So, it could be anywhere from, day trading to days or weeks. Some names we're holding months. We are still in some names like Dollar Tree right now. We're in a few names that we've held for some time, but again, it's really, I try to gauge things. I try not to get into this like box or fixed time frame. Buy a stock when the stock's breaking out of the base. I have my risk set where it's an acceptable amount of risk, and then I stick with the stock until it looks like risk outweighs reward, until I start seeing that risk is outweighing reward. The upside is less than the downside. And that could, in the beginning of a new bull market, I mean, you could be in a stock and it'll ride the 50-day for a 400% move, and you can stick with it the whole time. And in a whipsaw market, you'd be lucky if you get it 2 days of action in the stock on the upside.
That's interesting you say that, because I think where most traders would struggle, and I'm sure most traders listening in would agree with me right now, is they take profits too early. They tend to book profits way too early. And that's why, I wanted to ask, as far as risk reward goes, let's say you're risking $1 in a stock, $1 to make 5. But how realistic is it for you versus an average trader to make, like, you may make 5. You're like, look, I was targeting 5. That's what I'm going to make. But maybe you take an average trader might say, oh, I'm up $1.50 and I'm just going to take profits because that's what a natural tendency of a trader would be. What do you say to risk reward and how's the best way for a trader to approach it?
Well, first of all, I think the average trader could do just as good as me. So I started off as an average trader. As a matter of fact, I started off as a horrible trader. So I was terrible and did everything you could possibly think of wrong for about 6 or 7 years. So the average trader actually has a big advantage over the pro. The pro has to put, when I first started trading, I was buying 100 shares, 50 shares. Now I buy 20,000 shares. I might buy 50,000 shares. So I have a liquidity issue at some point. So to move that kind of, those kind of, and that's actually relatively small. If you an institution, a hedge fund or a mutual fund has to buy millions of shares. So it's a big difference. So as far as, the risk reward is concerned, like I said, the average guy, well, let's put it this way. If you were one to be taking profits too soon, in 2020, you would have made a fortune. And the guy who waited for that 4R, 5R trade, he's the one who gave back everything on almost every single trade, or probably a good 70, 80% of the trades, and ended up either making nothing or losing money. What we found was, looking back, and that was the one thing that I did right, was I very early on identified that theme and stuck with it, because it never changed. It just kept working. But all the people that we talked to that did great in this last year or so, they all changed to very short-term trading as far as the the upside was concerned, taking those profits a lot quicker. So that changes. That's the dynamic, is that that risk reward ratio, it's not always going to be the same in every environment. Now the ratio, you want the ratio 2 to 1, 3 to 1 minimum, but the amount, whether it's going to be a 5% loss and a 12 or 15% gain, or if it's going to be an average 7 or 8% gain and maybe an average loss of 3 or 4%, that's where you've got to gauge what's going on and what the theme is in the market.
So how often do you have to shift gears in the market, would you say, and how easy is it for you before you recognize, like, hey, the market conditions have shifted, I need to stick around longer because these trades are going to work out a whole lot longer than I had expected? Or what I'm saying?
Yeah, it's a good question. I mean, so I view the market each year, I start off thinking of the market as a 12-inning game. So I never get pressured. Like I don't start forcing anything. No matter what happens in the market, I never, even if stocks start taking off and blasting off, I don't just rush in and start getting, concerned that I'm going to miss anything. I have 12 months to get my return. That's how I look at it. I look at each calendar year as that's where I start off, and that's the year I'm looking to get that big return that if I can. Of course, risk is always first. I'm always, making sure that I'm covered on the downside. So I ease into the market and I start trying to find what that theme is. And I usually tell people, my trading is about stocks, tactics, feedback. Those are the three things that I gauge. So the first thing is, are there stock setups? Are there stocks that are even meeting my criteria that are going to give me an opportunity to even put my strategy into play? There's periods where I'm just out of commission. It's someone else's turn. It's the value guys. They're going to buy off those deep oversold conditions. I'm sure right now with all these stocks down 60, 70, 80%, there's value guys are having a field day buying up the bargains. I'm not going to be in that category. I'm going to wait. So are the stocks there? Then the second thing are what kind of tactics within my strategy. I'm not going to change my tactics. It's not like I have, it's like a tool bag. I have certain tools in my bag, but I have a certain, strategy. I have like a carpenter, I'm a carpenter. I'm not a plumber. So the plumber is going to have different tools than the guy who's working with wood. So he has to use those tools to build a house. The guy has to use his tools to be a plumber. So what tools can I apply to those stocks now? And then I'm going to try that. I'm going to apply some of those tactics and try to get an idea of what the theme is through the feedback. What feedback am I getting from those real trades that I put on, or at least maybe watching some of the pitches come over the plate before I take some, and get the feedback of the market and let the market tell me. So this is how I rarely ever get into any big trouble, because I'm never guessing. I'm never going in there and putting on big trades and saying, I think the market's going to turn here. I think the stock's going to turn here. This thing's been plummeting. I think it's going to, find the bottom here. I'm always getting confirmation, and I'm always making sure things are moving in my direction. So what I say is, the market's a train and I'm the caboose, and I follow, and that's really the key. And I found that all the great trend following traders, that's what they do. That's the secret, if you will.
Okay, well, so let me ask you this, and as far as gut instinct, because I got a gut, and I'm thinking my gut might be much bigger than yours at this,
Okay.
at this stage of the
Kind
game.
of big right now.
I don't know. Anyway, how much do you trust your gut instinct in the markets?
Very little. I mean,
It's all confirmation bias then.
Well, my gut is very good. And most people, I think, that had my level of expertise or my amount of time in the market, had my degree of success, would probably get very cocky in their trading, and it would probably be their demise. And that often happens, where you get good at this, you do really well, or maybe you don't get good, you just do really well. You do really well, and now you think you know something, and now you abandon what got you there. So I guess my main strength is that I'm just as disciplined today as I am when I knew nothing. So as much as my gut might say, hey, I really feel the market's bottoming here, I'm still going to wait. I'm still going to wait to get the setups, to get all the confirmation. And maybe I would have been right if I just bought the low. But again, I'm still going to stick with that discipline. I just mentioned this just recently in a talk that I did, that I used to play a lot of poker. I retired for a while from Wall Street after 2000, when I felt that I made a big market call, that I thought the market was going to a big bear market. I took some time off, and all I did was play poker. I played poker 4 days a week. I played at casinos, mainly at Foxwoods in Connecticut at the time. And during that time, there was always a game there, like a 10 and a quarter game. There was always a 1-5 game. There was always a 2-5 game, a 5-10 game. There was all these various games. And I know I'm moving into sort of another subject, but getting away from your original question. But so I would play this larger game. Right. I played this larger game, this 10 and a quarter game, which at the time was about the largest game there. And then every now and then, the tournaments would come, and we'd play the tournaments. The big tournaments would come, and all the big guys would come. All the Chris Moneymaker at the time, those names are probably old now, but all the big guys would come. And a 5,100, a 100, 200 game would break out. These big games would break out. And then guys would go in there and they'd play this big game and then they get stuck. They get stuck a huge amount of money because maybe they just had bad luck that week, and then those guys would leave, the tournament would leave, and we're back to the 10 and a quarter, 5-10 game. And now it takes forever to get your money back. You got to grind to get what you lost in that 1 week. So you have to make sure that the game's going to be there. You see, and I'm going back to what we were talking about before. The smaller trading, the quicker trading, the swing trading, and those, some people say, oh, those small, I don't want to hold for that, do all that trading, hold for those small moves. Can you really get a big return? Yes, because those are always there. A stock is always going to go up 10%. 50, every stock goes up 10%, but not many stocks go up 100%, 200%, 300%. So I know I do this often. I digress into a whole nother thing, but
that's okay.
What was your original question?
I forget.
Yeah, you forgot too.
But we were just talking about, I mean, it's really just, volatility in the markets, I think. And we were also talking about, risk versus reward, but
I'm sorry, thinking you know something. No, we were talking about thinking
your gut, the trust in the gut.
So here's what would happen though. I would sometimes go to the smaller game. I would go in there and there would be a waiting list for the 10 and a quarter game. There'd be a waiting list. And those of you, know poker, you know what I'm talking about. Maybe those of you don't, but the 10 and a quarter game are the blinds and no limit poker. So I would be waiting on a waiting list for that 10 and a quarter game or that, 25-50 or 50-100 game. And they'd say, well, the 1-2's open, or the 5-10 or the 2-5's open. So I go sit down at this small game and then I just start throwing money around, and I'd lose more in the small game than in the big game. I'd end up putting myself in the hole in the small game. So now I play poker. There's some private games that I play at with friends, and I play really tight, and I'm playing with $500 or $1,000 in front of me. And then people are like, come on, man, you're a freaking multimillionaire. Throw some money in there, loosen up. And I say, no, you see, I play disciplined, because why play this game? Why not play it the right way? Just because it's a smaller amount of money. It's the same thing with trading, whether you're starting with $2,000 or you're starting with $2 million, you got to apply that same discipline. You have to keep that same discipline all the time and be consistent and never drift from those rules, or your 2,000 won't become 2 million.
And it's going back to trusting your gut. Your system, you're following a system, and it's the way that you play that system that works. And so I think that's really an important takeaway for traders. So let me ask you this: how consistent has your system been? As far as keeping it the same over the years, or how often have you tweaked what you've done over the years?
I haven't tweaked anything in over 30 years. The only thing I'm just better at it. I'm better at it, and there are a few little technical tactics that I've added, but I don't think I've deleted virtually anything out of the system. I've just added a few other tactics and observations, but they're all within the same system. It's just I've noticed and been more aware of some nuances that were added into it, and I'm just better at it now. I just have a better understanding of it, and I'm better at executing it now, and I'm certainly better at teaching it. And that's one of the reasons why I came up with things. VCP has become a vernacular now. Volatility contraction pattern, and some of these things, cheats, load cheats. Now, these are all my terms that nobody was saying these things 20, 30 years ago. I coined them, and now they're sort of vernacular. The reason why I came up with them wasn't for me. It was to try to teach other people on how to do this, so I can have some type of explanation and say, here, this is, give them names and explanations. The VCP was created just simply because I had so many people come to me trying to figure out the O'Neill strategy, and with coupled handles, and they'd say, hey, look at this coupled handle. And it was nowhere near a correct base. So I said, we need to come up with something else that is going to allow people to be able to look at this pattern and to understand what it's supposed to look like to be constructive. And that's where the VCP came in. So that's about it. That's the only thing that's changed is I just, came up with some things to be able to teach it.
Well, I must say, Mark, those are statements that come from a true veteran professional like yourself, because I think what a lot of traders, and I've been dealing probably like you with a lot of different traders over the years. A lot of traders believe that if I add this or add that, it's going to make me more money. But isn't it really just coming up with a system that works for you, which might be different than somebody else, but working for you, and then eventually adding size as you become more comfortable? Would that be a correct statement? And what would you tell traders that are just trying to add different indicators to make it better?
So the problem that we have today is a complete contrast to the problem that we had when I started. When I started, there was no information. I was going to libraries and reading books that were 60 years old on tactics that never worked in the first place. Okay. So we had to figure everything out by ourselves. You mentioned drumming. I was a professional drummer and I was in the music business. And when I had to figure out a song, we had to take the record and we have to play the part and then put the needle back and listen to it, put the needle back 100 times. Now you just go on YouTube and the guy who wrote the part and played the part on the record is teaching you it on YouTube. Okay. So things are a lot different now. You have all this information, but here's the problem with every solution. There's a problem. With every problem, there's a solution. We have information overload now. Now there's so much information that you don't know who to listen to. Everybody's a self-proclaimed expert. And there's a million experts out there and there's a million ways to do it. And there's all kinds of algorithms and, you'll be led to believe that you could just hit a button and everything's going to work. The trades are going to be done for you. That's not going to happen. That's not going to happen for any length of time. It might be for a little while, but that's never going to happen in perpetuity. So you still have to work. There's a lot of work to be done, but you have to now boil it down to the information that's relevant. The less information is what you want. You want the least amount of moving parts. That's something I learned from Bill O'Neill. Bill O'Neill used bar charts, few moving averages and volume, and made hundreds of millions of dollars. I said, if that's good enough for me, that's good enough for me. If you could make a couple $100 million with using that, then there's nothing more. It's not necessary to add more moving parts. What's necessary is to learn how to read charts and understand the fundamentals of a company that well. So bring it down. And again, I know I'm going on and on, but when I first started training traders, when I was in New York and I was running hedge fund and I was training traders, when they came to work for me, I would start them out where they couldn't trade. They could only trade one pattern and it had to be within a certain RS range. It would be like, let's just say 99 to 97. So I gave them like 3% of the market and they could only trade, let's say, this particular pattern until they were successful with that. And they can double their account with that. I didn't let them move on to anything else. You're not going to learn how to trade anything else until you can do that. Then we'd build on that and we'd build and we add another pattern. We'd add some more tactics. We add some more variables and build and then broaden out and start adding more of the market to look at more of the market. If you can't take the best part of the market, the strongest, highest alpha section of the market, and you can't make money in that area, trust me, you're not going to make money in a big, broad part of the market. Adding more is not going to help you. It's going to confuse you.
That is wonderful advice to not just new traders. This is traders, from all walks of life and all sorts of experience. I know we've got about 15 minutes, and I'm going to address some of the questions that are coming in from the audience, if you don't mind. However, I have one question that really has been nagging at me since I knew that I was going to be spending this time with you, that I thought, yeah, I've got to ask Mark this. So there's been points in my career that the market has changed dramatically, where it changed the way that I approach the market. Namely is when we went from fractions to decimalization. That changed my scalping methodology, ruined it at that point. Yes. And I had to change what I was doing. So in your nearly 40 years of trading, how many times have you had to feel like you've had to gone through a monumental shift in your approach to the market, not due to other reasons?
Yeah, condition changes or something that
Condition
changed
changes, yes.
in the environment. And a monumental shift, never, not one single time. A
Really?
monumental shift in my actions, my discipline, yes, monumental shift. When I first started, I was holding losses down 50%.
Oh,
that
yeah.
needed a monumental shift. And then I shifted them to 10%. Before you know it, my average loss was running at about 4 or 5% over the long term. So that was a monumental shift. I used to be up on a stock 30%. I let it come all the way back and I lose money on it. That needed a monumental shift. I came up with a new rule. I'm never letting a big gain turn into a loss ever again. I have an absolute rule in stone. I'm never going to let a 30% gain turn into a loss ever, not one single time, unless it gaps down on me. So those were the monumental shifts. As far as in strategy, I've never made any shift whatsoever. Now, keep in mind, first of all, what I do, and the reason why I've spent my whole life with this is because these are timeless principles. This goes back. What I do and how I analyze the market, it would be the same for O'Neill, and it would be the same going all the way back to Jesse Livermore. And Jesse Livermore was one of the greatest traders of all time. And he's a perfect example of somebody who you could be a great trader, but if you lose your discipline, you blow up. Not only did he blow up, but he killed himself. So, and he's one of the greatest traders. Jesse Livermore made $1 million in one day and $100 million shorting the market in the 1920s. Adjust that for today's dollars. As a private trader. So nothing really has changed. Now, if you're in your case, the change to decimalization for day traders was monumental. That was a big shift. Yeah. And I think it was a very bad, that we can go on for an hour on this alone. And I could tell you all the reasons why. It was a terrible move. And what it did, it actually was supposed to create liquidity, and it did just the opposite. And that's because the people who make those laws aren't traders. Okay,
Right.
they're politicians and they're SEC people, and they haven't a clue as to what is actually going on, in the real world on the other side. So, but yeah, you're right.
Agreed. That's for another conversation.
That's another
Yes.
conversation. That's another conversation.
Mark, I'm getting all these questions. I watched your interview with Nick Leeson, and for those of you that haven't done it, 8Cap, which is our sponsor here as well, they sponsored you to do an interview with Nick Leeson, which I have his movie around here somewhere, who's the rogue trader, the original rogue trader from Barings Bank. Anyway, you guys should all watch that interview. But you were really, you were really hard on him, and I wouldn't say hard on him, but you really
I was soft on him, actually.
yeah, and rightfully so, because he was adding to losing trades. Can you just harp on that really quick? Especially, it's so valid in today's market. I think traders need to hear it from you specifically. Like, I'm in a losing trade, and I'm going to just keep adding, like Nick Leeson. Really?
Well, I already said to myself before the interview, if this guy comes in there and starts like being in denial and not, fessing up, then I'm going to be real hard on him. But he was just the opposite. He was such a gentleman, and he took such responsibility for it, and he was incredibly candid and transparent. So I actually thought I went quite easy on him. Actually, you don't know me too well, how hard I could go.
I saw you shoot.
Ask some of the Twitter followers. But again, Nick, he knows, what happened. I mean, here's a guy who was in his 20s and was put in a position that he should have never been put in the first place, probably. And even if he should have, there was no oversight whatsoever. So see, banks don't operate people think banks operate so well and are such, good risk managers. And it's so, you're a bank, and there's these big white pillars and everything's safe. It really isn't. It isn't as safe as you think. There's a lot of incompetence behind those pillars, and there's been a lot of debacles, and a lot of banks have gone under certain circumstances. Back in the 1990s, they had the S&L crisis. 1,200 or 1,400 banks went under in a year. So, but what was your original question?
I know. I was just going to say, I would say adding to losing trades in this environment, because I know we're in a situation right now where we're seeing extreme volatility. People are getting stuck wrong-sided in trades. And what's your advice to them that if they want to throw good money after bad, what's your advice to them?
Right. Okay. So I'm sorry, that was the original question. Yeah. And again, that is, first of all, averaging down, adding to losers, the problem with that is that at some point it might work. And then you're absolutely a dead man. You're a dead man walking, because then you're virtually guaranteed to blow up, because now you got rewarded for a habit that is, there's Paul Tudor Jones. I've tweeted this before, and a lot of people know the sign Paul Tudor Jones had on his wall that said "Losers average losers." Here's one of the greatest traders of all time. Paul Tudor Jones is one of the main guys that I modeled a lot of what I do after. Here's one, and when I saw that sign on the wall, when I originally saw that and said, this guy's one of the greatest traders of all times, and he has to put up a sign to remind himself not to do that. Not, first of all, just putting up the sign and from him saying that, I took that at face value. But then I thought about it a little deeper. Why does this guy have to have a sign? Is it that compelling? Yes, it is, especially when we're good at this and we start to think we know something. It's very easy to start adding to losers and thinking that it's going to bottom here and it's oversold and blah, blah, blah. But the bottom line is that ultimately that is what led to every major blow up in the history of the stock market. That is the culprit of every blow up. And the smartest guys in the world couldn't employ that strategy consistently before, long-term capital had Nobel Prize winners and to some of the smartest people in the world. And that's precisely why they blew up. We don't know if Cathie Wood is going to, blow up. I don't think she's going to blow up, but certainly there's a big drawdown here, and it could get worse, and it could even be worse sometime in the future, because we haven't even really experienced the big bear market here. I mean, a lot of these kids that are trading nowadays, they're 25 years old or 30 years old. They haven't seen anything major. They didn't go through the crash of 87. The crash of 87, if we had another crash of 87, which at some point we'll probably have something like that, we'd be down like 8,000 points in one day. Okay, yeah. Just think about that. That's the equivalent. In 87, when the market crashed, luckily I didn't have a whole lot of money back then, and I was out of the market. I got stopped out of the market, and fortunately, but people were going into brokerage houses and shooting their broker. Okay, people were jumping out of windows and killing themselves. Okay, that's how bad it got, and that's how bad it could get. Similar things happened in the 20s. People were like, that's never going to happen. We got circuit breakers. Bullshit. That will absolutely happen at some point. You can bet on that.
Yeah, so, and I'm interested to see, just because of all of the precautionary measures that markets have taken over the years, whether it's electronic, halts and whatnot. It's going to be a fascinating market that we're moving into. Do you mind if we address some of these audience questions?
Sure.
All right, Mark, Charles asks, have you been participating in the energy trade or simply just staying out of the unfavorable market conditions?
Yeah, that's really one of the few areas that's worked. I made an XLE trade that was perfectly timed. As a matter of fact, I got charts here. Let me see if I can just pull up the date. Tell you when we made the XLE trade. I sold it way too soon, but then ended up rolling into some of the energy stocks. But I bought XLE on January 3rd. So that was really that was when we started. I mean, it really was at the start of this whole thing. And since then, I mean, I'm right now we're in Oxy. We own some Occidental Petroleum. We're in some of the oil names, the energies, some of the shippers, the ag stocks. That's what's been working. Now, this is a lot of commodity type names now, and these are generally short lived. Also, I just saw rotation into names that are maybe more recession proof. Like I own O'Reilly, I own AutoZone, Dollar Tree. These are names that when the market, when you start looking like you're going into recession, sometimes they perform because people stop buying new cars and they start just fixing their cars. Dollar Tree, they go to the dollar store, they start going to the dollar store, and those will generally be sort of the defensive money will go into some of those areas.
I'm glad you said that, actually, because Ray, he asked this question. Mark, do you always trade stocks, or do you only trade stocks, with great fundamentals? There are a lot of times that stocks with bad fundamentals are dominating the market, breaking out from VCP with great relative strength.
Right. So I have something that I employ that I call relative. Let's just put it this way. I have relative symmetry and I have relative prioritizing. Relative prioritizing is where if one thing is strong enough, it will override the other. I'll give you an example. So if you have a biotech stock, I want to trade a biotech stock. If it's coming out of a great chart and it's got huge relative strength, super high alpha, but no earnings, I'm going to trade that because that a biotech stock generally doesn't have earnings. 70% of biotechs don't have earnings. So that is within its character. Now, a growth stock, if you have a growth stock and it has no earnings, well, then you have to find out what's the story here. What are they going to do to get earnings coming in, down the road here? Or let's just say you've got earnings, but you've got no sales, right? And you look at them, profit margins is the story behind it. You've got expansion and profit margins. Well, you could only cut costs for so long. You can only improve productivity for so long. Revenue has to come in at some point. So that I automatically know that's going to be a shorter lived cycle. If the stock's already up big on that and breaking out of a second or third stage base, but you don't have the sales there, that's going to be a situation that's a lower probability. So again, if you go to my first book, I talk about categories and catalysts. You need to know the category that the stock's in. If it's a biotech, well, earnings aren't that important. Now I'm trading off the chart. If it's a turnaround situation, you're going against easy comps. Now, 20%, 30% in the most recent quarter is not a good report because you're going against very easy comps, and there should be 100, 200% earnings in the most recent 1 or 2 quarters because that's what you're going to see in a strong turnaround. So you basically, I have 6 or 7 categories that I put, basically 4, but there's a couple subcategories that I put the stock in, and then I assess how important each thing is. But here's the underlying rule: regardless of any of that, stock has to be in an uptrend, and it has to have the chart and the RS. If it doesn't have that, I don't care how good the fundamentals are. I don't care what the story is. I'm not touching it. So yes, I will buy stocks that don't have the fundamentals, but I'll never buy a stock that doesn't have the chart and has just the fundamentals.
Thank you for answering that question. That is a great answer. Now this is going to be a good one, I think, for a lot of traders. Ernest asks, are you short names in this bear market? Since it is a bear market, are you short any names?
I'm not short. I do go short from time to time. A lot of times I'll short the indexes when I see the markets rolling over and I get that sell signal, if you will. But let me tell you 2 things about shorting. First of all, 3 things. 1, I'm not very good at it. That's number 1. Number 2, I have made, out of all my money and all my net worth, I've made less than probably 0.1% on shorting. So, and I was even short on 9/11. I was short a huge position on 9/11, going into 9/11. It was one of my biggest trades ever. But over my whole career, you can, it's less than 1%, less than probably 0.1% of my net worth. So I view shorting as unnecessary. The real money's on the upside. Because again, a stock can go down 100%. That's it. And of course, that's not going to happen too often in a short, maybe once in your lifetime. So, but a stock can go up thousands of percent, 10,000. It can go up to infinity. So the real opportunity is on the long side. The thing is, if somebody always, they want to do something all the time, if you make enough money in the bull market, you won't have to worry about shorting in the bear market. You can take a little time off and enjoy some time, doing your post analysis and reading my mindset book.
There we go. Do you have time for just a couple more?
I have time for a bunch more.
All right. Well, all right, great. Nuno asks, when we see this change in volatility and few breakouts are working, how do we know if we're taking profits too early or not? Since the volatility was smaller before, our loss percent could be bigger than today, like let's say 5%. If we consider taking profits at 5% nowadays, we would get only 1-to-1 risk reward, considering that average loss from before. How should we handle this market shift?
It's a great question, and the answer is that if you're going to have a less, we always want to maintain that risk reward ratio. So very simple. You only have control over one thing. You can't control how much a stock goes up. You can't control how many of the stocks that you buy are going to go up. But what you can control directly, you have direct control over the loss. Think of them as sliders. Some of them are automated sliders. They're moving on their own. You have control over that one slider, and that's the risk side. So if you're getting 5%, well, now you got to back into trades that have a tighter risk, and you have to take 2% on the stop. Now let's just say that's not possible. Okay, it's too tight. I'm choking off the trades. My strategy, that's too tight for my strategy. Then guess what? You got to wait. You got to wait until the setups come and those better setups start working. But I'm always gauging my upside. I'm always trying to figure out if you can figure out what your upside is on average and how often it's going to happen. The loss side becomes a mathematical equation. It's a simple mathematical. It's the same thing that insurance companies do. An insurance company can figure out with almost perfect accuracy where a large group of people is going to die on average. They can figure out the mean and the median almost to the day, or very, very accurately. They could say 77.7 years, this group is going to expire. Think of that as your gains. Okay, you figure out where are your gains on average going to expire. Not any one gain. That's not important. What's important is where the average is going to be, just like the insurance company. Now, like the insurance company, they set their premium based on that. Once they can nail that number down, setting the premium is just a mathematical equation. Once you nail that number down, setting the stop is a mathematical equation, just like the insurance company. No different. Use actuary tables on your gain side, and you'll know exactly where to set your stop.
That is amazing advice. Thank you so much, Mark. Yeah, a different Mark asks, what's your average hold time on a trade? And if less than a couple of weeks, do fundamentals really, do they matter at all?
Well, yeah, you see, again, the shorter the time frame, the less the fundamentals are going to matter. Absolutely. If you're just scalping and taking these, couple day moves, you could trade pretty much anything. You do have overnight risk. So you got to be careful going into earnings. And there's still, I would prefer to have the fundamentals. I'd love to have it all. But yes, as your time frame comes down, certainly to these very, very short moves, then you're going to want to trade mainly on the technicals. And that's where right now, yeah, I'd be trading, much more short term and trading purely on the technicals. The other thing too is to remember that you want to be an investor in the early stages of a bull market and a trader in the late stages. And in the throes and the real momentum phase of a bear market, you want to be out. So when I first go into a stock coming off of a low, and we don't know if it's a low until after the fact. You get a follow through day, maybe you start seeing some stock set up, but things start working. And I might have just gotten the next market leader in maybe it's a new name that hasn't led previous cycles. It's breaking out of a base right off the lows of a bear market. Well, that's a stock that I don't want to sell at all. I don't want to take the profit. If that runs up nice and quick, I'll probably sell half of it and keep a little bit. Just think about it. Even if you traded Amazon back or one of these big names that became multi-year secular winners, if you kept 5% or 10% of your Amazon trade breaking out. When I bought it at 97 coming out of the first base. But that would be a huge addition to your wealth or your net worth, just that small position. And like I said, these stocks can go a long way, just, holding the 50-day when you buy them in the beginning of a bull market. Later stage, now the market's been going up for 2 years. You're coming on a third, fourth, fifth stage basis. Now you want to switch over and start trading. And the later that bull market gets, the more you're going to shorten that time frame.
This is a personal question I wanted to ask you about bubbles, because you get like these bubbles in the market, whatever it is, if it's a tech bubble or it's crypto bubble, whatever the case it may be. But when you see a bubble, do you start automatically think as a trader, I'm going to fade it? Or do you think, man, this is the time where I can make a lot of money on these big breakouts? How do you approach bubble type activity?
Usually when everybody thinks there's a bubble, there's not a bubble. Bubbles happen when nobody thinks there's a bubble. When I go back and I look at 87, when I go back and I look at 99, topping into 2000, and we look at all these periods, when we look at crypto, when crypto just was hot and before it had a big pullback, nobody was saying it was a bubble. They were saying you got to own crypto. Every friend that I had on Facebook was just bragging about their crypto, was buying more and saying how this thing was going to $1 million. So when everybody thinks there's a bubble, there's usually not a bubble. So that's first of all. Besides that, though, look, I know when I see bubbles, I don't judge bubbles by stocks. I judge bubbles by people. When my phone's ringing off the hook and all my friends want to quit their job and ask me if I'll help them become stock traders, I know we're in a bubble. And so that's a more accurate indicator for me. So the sentiment is what you really start to see, and the sentiment around a bubble is not bubbly. It's as far as people saying there's a bubble, it's just the opposite. People are saying it's different this time. This is going to the moon. This isn't going to stop. There's not a bubble. I know this is not like they were just saying not long ago. This is not like 99. It's not like 2000. Well, guess what? When I was pointing out that all these stocks were setting up. If you go back to my Twitter feed, you'll see I said it over and over and over at nauseum. People were tired of hearing it. I said, we're setting up an entire generation of traders for the biggest losses they've seen since 99. If people say this is not 99, you're an old man, you don't understand, you know what's talking about, diamond hands now. And guess what? It was so stealthy. It stuck them so bad because the index masked it all. Meanwhile, everybody blew up. The brokers are all down. All the stockbrokers down 50, 60, 70%. They blew their books up. All those diamond hand guys, you don't hear from them anymore. They're all gone. They're all wiped out, holding their stocks down 80, 90%. It happened. It happened beneath the surface. It happened in all the growth areas and all those hot areas that nobody thought there was a bubble. SPACs, everything. People were defending those to the death. I mean, I was getting close to having death threats over saying a bad thing about these growth stocks or about crypto or about SPACs. It was incredible how passionate people were about these trades. And then when you start seeing rap videos coming out about crypto and stuff, that was pretty much. I thought that was pretty much the writing was on the wall.
It was done in 2017.
About SPACs.
Right at that moment when that video came out.
Yeah, the video about SPACs, that was pretty much it.
Hey, Mark, Musab asks, Mark, how do you adapt your mindset to a bigger account, especially towards the start of your trading journey? If you start with $1,000 and then you end up with $10,000, how do you get mentally okay with seeing 10 times the loss? And that actually is such a great question, because I think a lot of people have that mental barrier when it comes to money. So how do you get over that, Mark?
Well, that was a challenge for me, growing my account. And then I had a few nice spurts in the early 90s. And for that 5-year period that Jack Schwager talked about in his book, I went from a small amount of money to a very considerable amount of money. I became a millionaire, and now suddenly I've got buying power of millions of dollars. So it was very difficult for me. And I actually took a little period where I wasn't performing nearly as well because I got more conservative. But what I started to do and learn about myself was that I needed to just become even more risk adverse from on the downside, but still allow the upside. This is what I call, and I talk about very often in my talks, about creating what we call asymmetric leverage. This is another thing that you hardly ever hear anybody talk about, but I think it's probably, now that I'm talking about, you're going to hear about it a lot. Asymmetric volatility, asymmetric leverage. And it's basically skewing a bell curve, and you, of course, you want that bell curve to be where the loss side, say it's on this side, to look like that, and this side to come way out here, right? So now you want 3 standard deviations to the right, and you want the left to be crimped. That's creating your asymmetric leverage. So what I did was I honed my timing, and luckily over years I've gotten better at this. So I've honed my timing more, and I'm more selective. So I've actually tightened up on the risk more and more and more to where I can trade those larger positions. And that's how I had to address it for my own comfort. I don't like losing money. I hate losses. I started off poor, and that's the difference between some people that start off poor, some people that start off wealthy. Wealthy people don't have that looking back at the fire and saying, I ain't going back in there. There's a different motivation. That's a poverty mentality. I had a poverty mentality for most of my life because I grew up in poverty. So I had to fight that. I had to fight that poverty mentality. That's something I talk about in mindset. And people that grow up rich don't have that, but they have another problem. They have an entitlement feeling, and they get too ambitious and don't look at the risk. So they're on both sides. There's pluses and minuses, and the key is to strike a balance. And that balance, though, where you want imbalance in your risk to reward. That's where you want the imbalance. Always try to create the imbalance in the risk side to the reward side. That's where you want that, and that's what I've been able to create, that imbalance where the risk is very, very small. I'm always moving into trades from a very low risk position.
All right. Well, that's great, because I think that weighs on a lot of people. I did prop trading for 5 years, and when you're dealing with such larger numbers, sometimes they can wear on you psychologically. And I'm assuming that's great that you explain that in your book on how to deal with that in the Mindsets book.
Well, some people, can deal with it. They love the adrenaline. They love the excitement. They have the confidence of, coming back. I look at every 5% or 10% pullback as a potential bankruptcy. That's how I look at every trade. I think of every 20 or 30% decline started as a 5. Every 50, 60, 80, 90% debacle started as a 40 or 50. So the only way to keep it from getting to that is to cut it short. So, and the bigger that the positions that I put on, the more my lifestyle is at risk. And at this point, at my age, I'm not going to be able to go and replace tens of millions of dollars very quickly. When I was 25, 26 years old and I had an account that was a couple $1,000, and even when I grew it to 30 or 40 or 50 or 100,000, that was something that I had time, and the amount of money wasn't so great that it wasn't recoverable. Now it's a different story for me. So that's a personal decision that you have to decide. But the main thing is that the general rule of thumb is the bigger the risk, the bigger the exposure, the more capital and the more risk there is, the more you have to approach it from a smaller risk standpoint.
And that's,
Liquidity wise, stop wise, everything.
And what I think the takeaway there that I got was, a 5% loss. Every 50% loss started as a 5% loss. I mean,
yes. Yep. Every 90% loss.
No truer words there, right? So
if you don't
DeJoy
treat it that way, you'll see those bigger losses.
I'm sorry?
You don't treat it that way, if you don't treat those small losses as potential big losses, you will see big losses. It's that simple. You'll get into that mindset, and you will see those big losses.
Gosh, it's wise words. This actually goes alongside with that question. DeJoy asked, hey, I have a question. How does Mark apply progressive exposure, or I'm assuming adding to positions in this market?
Well, it's not only adding, it's also, more importantly, is making sure that when you are doing poorly in the market, when the market's not, when the stocks aren't giving you that feedback that we talked about, that you're not continuing to trade the same size, or worse, trade larger. And that's what most people do. That's where they really get in trouble. They start adding to the positions. They start revenge trading. They want to get it back, and they start trading too much, too fast. And then they get themselves into a really bad situation, and they get themselves into a deep hole. Now the market starts working. Everything's working. And guess what? You're digging out of a hole. And all the progress in this beautiful next bull market, you're just getting back to even. And that's what I call compounding mistakes. You want to compound money, not mistakes. So the thing that is elusive for people, they don't seem to understand. You got to go back to the math. What really hurts your performance? People look at my performance, they go, "You've had all these years." I don't know how many now. I think I've had 11 or 12 years out of the last 20 or so that have been up 100%. Well, guess what? That's not the secret. The secret is I've also had, I had no down years. I've had maybe, I think, 1 or 2 down years in like 30 years. So, and I've had flat years. I've had years where I'm up just a couple percent, and hardly any return, but I'm never losing big. I'm never losing big. So that's the key. That's the real key. It's the losses that work geometrically against you. That's what hurts your performance. If you never lost, you only got to get small returns, relatively small returns, to compound them, and you can have a big return. But you could get huge returns, and if you have 50% drawdowns, you'll get nowhere. You'll get nowhere. And so again, the downside is really the key. That's the whole key, and I'm going to keep harping on that.
Mark, somebody in your area that I traded with, and I would say is the best trader that I've known personally, and I traded for him. He didn't lose. Mm-hmm. At all, like very little. And that's, he said the exact same thing. He's unknown. He doesn't want to be known, but he is
I'm sorry to interrupt, but I gotta say one thing, because it's really important. People take everything I say, and probably what you say too, very literally. Yeah. I lose all the time. I lose 50% of the time. Half my trades are losses, but I don't lose yearly. Monthly, quarterly, very seldom do I have any kind of real big drawdown on a monthly, certainly on a quarterly, and a yearly, virtually never. So my risk reward is I'm always getting odds on my money. But I have tons of losing trades, but they're small. They're small relative to my gains. And if I was a day trader, they'll be the exact same thing. It still would have that ratio.
And thank you so much for actually, rephrasing that, because that's exactly it. His losses are just very minimal, but he did lose quite a bit, but they were very small, and his gains were exponentially bigger. And that was his success. And hearing it from you is golden for so many traders to hear that. I think it's absolutely just words of wisdom that they need to hear. Mark, I've truly enjoyed, you've spent so much time with us, and I just want to say I'm truly amazed at your wisdom that you've bestowed onto the Trader Summit community. I want to thank you so much, but I want to also ask, how do traders follow your work specifically, and where can they go see that the great drumming that you do?
Well, I guess you can just, there's some videos, you can just YouTube and Google me. So I'm certainly not here to push anything, any products or anything. I'm here to try to help everyone. And, I'm very easy to find.
Well, Mark, I want to say that from the Trader Summit community, this has been a great way to wrap our Saturday. I know a lot of people have been waiting patiently, and I've got so many more questions that we'd be here for hours on end. And I just want to say thank you so much for spending your valuable weekend with us. We truly do appreciate it.
Okay. Yeah. And I know there's lots of questions, and I'm sorry we couldn't get to everything. I do my best to try to give you as much color and as much as I can in the shortest period of time, but maybe we'll do it again. And I hope it's been helpful for everyone, and God bless, and good luck to everyone.
Thank you, Mark, so much for your time.
Thank you, sir.
Take care. Bye-bye.
Bye.
Bye-bye.